All right. Fed Chair nominee Kevin Warsh wants more space between the Fed and the Treasury. Is that a good idea? New Japanese Prime Minister Sanae Takaichi wants to tighten immigration and loosen monetary policy. Aggressive Abenomics style stimulus while cutting taxes. Is that a good idea? And the U.S. jobs report was better than expected. Far greater than expected in all caps, said President Donald Trump, adding that the U.S. should, quote, be paying the lowest interest rate by far. Is that a good idea? And finally, Google parent Alphabet borrowed £1 billion for 100 years, paying about 6% right now to fund AI. Is that a good idea? We'll discuss all these potentially good ideas and have 3 potentially good stock ideas of our own for you in this edition of the Curia Investment Show. As always, I am joined by trusty companion Eoin Tracy in Dallas, Texas, and Xiaoping Wang, analyst at Curia, who will come on later for a stock idea. So, Eoin, welcome.
It's always a pleasure.
Pleasure is mine, Eoin. So, let's start with Kevin Warsh. So, basically, we're all trying to figure out what he is. He was a hawk long ago. Now he's suddenly sounding more dovish, or semi-suddenly sounding more dovish. He basically is of the view the Fed needs to get in and out more strategically and not just stay in and have this big balance sheet. I think a lot of people would be on board with that. He thinks we should print less money. I'd ask, does he mean the Fed or the Treasury? Because both can sort of add money into the system. But my big question, Eoin, for you, he wants to get back to this 1951 agreement, I believe, which basically advocates for more separation between the Fed and the Treasury. He thinks the Fed and the Treasury have gotten too close, too cozy over the years. Do you think he's right, or is he just kind of using this as leverage to do Trump's bidding?
Well, I think there's talk about how the Fed and the Treasury should talk to one another. And if they're going to reduce the size of the balance sheet, which is what Warsh is talking about, well, that could be enormously disruptive to the Treasury market. So some
just a very big balance sheet.
It's an enormous balance sheet. We're talking about $6 trillion.
Yep, and, $6.5 trillion.
And during times of crisis, it has tended to go up rather than down. So there's this big question then about if they are going to reduce that even further than they already have. Is that going to have a big impact on the Treasury and how it can issue new debt, and where those maturities would be depending on how the Fed is going to reduce the size of its balance sheet? So that necessitates that they talk to one another, that they have a little bit of timing about when does one sell and when does one issue.
It would be malpractice almost if they didn't, right?
Well, yes, it would be almost malpractice. Now, of course, when you get the Fed and the Treasury talking to one another, that's also complicity.
Collusion, yeah.
So then, and it's all academic until there's actually a problem. And what happens when there is a problem? That's the next question, because debt monetization is not foreign to the USA. It was a very significant factor all the way through the 1950s and the 1960s and the 1970s. And in fact, one of the reasons why the Bretton Woods system was abandoned is because of debt monetization. That this was a really significant factor, and there was a huge correlation between monetization of debt and inflation. So when we hear Warsh talking about going back to the way it was in the 1950s, well, the 1950s was a significant era of debt monetization.
Interesting. And for someone who's new to economics or investing, can you explain debt monetization?
Well, debt monetization is the most happy circumstance for a government, because the central bank literally just prints the money for you to spend. So it doesn't matter how many bonds you issue to raise money for your government spending, the central bank will buy them. And that helps to try and bring down interest rates. Of course, what it doesn't do is bring down interest rates, because the wider market goes, what are you doing? You're actively devaluing the currency, so we don't want your debt. So actually, even though they say it brings down rates, it in fact results in rates going up because it boosts inflation.
And it dings the credibility of a country, of a currency, of an economic system.
And because this has been going on for years already, because you have to also remember that debt monetization is the same thing as quantitative easing. Quantitative easing is exactly the same thing, that the central bank inflated its balance sheet by buying all the debt that the Treasury was issuing. It just didn't arrive in the main street. It stayed within the banks. So last time this was done, it did not, or actually quantitative easing did not result in the same kind of inflation we had in the 1970s. But the pandemic debt monetization did, because we sent money directly to the regular people, and they went out and spent it. And so when we look at what the potential future is, well, they saw how effective sending money directly to people was. And I think that that is going to be part of the playbook going forward.
And just to double click, and I'm going to nitpick on something, and maybe you're okay with it, maybe not, but technically speaking, QE can be a little different. I mean, pure debt monetization, at least to me, is Treasury wants to sell some bonds. Guess what? The Fed wants to create some money and buy them. But QE these days can have multiple forms, and you could have forms of QE where the Fed is just buying stuff from the private market, maybe with created money. So it's still mostly the same, but like it's a little bit different if they're buying private market assets, right, than something directly from the Treasury, or is it all kind of in the same bucket to you?
Well, it's about crowding out private capital. So that effectively is debt monetization, because if you create a bigger market for anything, then you create more demand for it. It reduces, it really helps to reduce the difficulty of selling. So if you are an issuer of bonds, regardless of whether the private sector is buying them or the central bank is buying them, if you've got two buyers for them, then it's easier to sell than you've only got one buyer.
Got it. So wherever that money is going, whether directly or indirectly, it's competing, it's propping up those prices. I get that point. So let me ask you this then. I showed a chart of the Fed balance sheet, $6.5 trillion right now. It's come down a bit from its peak, but it's still a lot higher than typical. My question is, if Kevin Warsh is serious about unwinding the balance sheet, what about those who are of the view that we've got this liquidity-driven stock bubble? In other words, stocks are up not just because corporate earnings have been good, but stocks and really other assets too have gone up a lot simply because there's so much money in the economy. And if the Fed starts unwinding that balance sheet, what happens to that situation?
Well, this is, I think, one of the central issues, that financialization has been a very significant contributor to asset price appreciation over the last maybe 17 years. And financialization has contributed a lot more to economic activity than regular just economic people building stuff, making stuff, selling stuff, right? So if they were to reduce the size of the balance sheet and bring it down to below $1 trillion, well, then that would really impinge all of the, and think about, all of the companies, the financialization, how many people have made their fortunes from private equity, from private credit over the course of the last maybe 15 to 18 years. That's a really significant number of people. Well, that was the financialization trend. And if they were to reduce the size of the balance sheets and take all that liquidity out, well, then all those companies would be in exceptional difficulty, but so would the wider economy, which kind of means that they can't do it. They can talk about it. They can try to bring down inflation. I think the primary reason why Warsh wants to reduce the liquidity is because he wants to try and bring inflation back down.
So you're telling me,
I really don't think he can.
You're telling me all these PE people are not as smart as they thought. They're more just riding a tailwind of Fed liquidity that's helped basically everybody over the past, since the great financial crisis, basically.
Well, don't get me wrong. There's a lot of smart people in that industry, but I think the really smart people were the ones who were early.
Yeah, So if he really can't functionally do this, I mean, Trump would love him to lower rates, and it sounds like he's signaling from everything I've followed of him, and which is not all, but he's signaling that he's happy to bring down rates because we've got productivity on the rise, we've got deflation from technology. I don't know how real that stuff is, but at least it's his cover for lowering rates, right? But then on the other hand, if we start unwinding the balance sheet, start selling these treasuries, and by the way, we talked about this on this show before, foreign governments now own more gold than U.S. treasuries. They're a little less excited to buy treasuries. So I don't know who's going to buy them, how many marginal buyers we have out there, right? But that's going to absorb some liquidity. Your point would be eventually Trump's going to get mad at him for cratering the stock market if he's really seriously trying to quickly unwind. I don't know if he'd want to do it quickly or whatever pace he unwinds it. It's going to have some pretty big damage, and you don't think we can bear that. So he's just not going to do it, you're saying.
Look, the stock market is selling off right now. And, Kevin Warsh isn't even in his position yet. And this is pretty typical for what happens ahead of a new Fed governor, that they come in with all of these heady ideas about how they're going to make the world right. And then the stock market sells off and they get a reality check. Yeah. I think that's exactly what we're seeing right now. So, when he gets into his position, he's going to be faced with the reality of being responsible for his decisions rather than just talking about it. And, I just don't see how they can reduce the size of the balance sheet. Now, something to do bear in mind. One of the reasons why gold is so firm and has gone up so much is because of this condition. If for any reason the US government were to decide that it was going to start reducing the volume of debt that the government is issuing and reducing the amount of liquidity in the system, that would be very good for the dollar. And actually, that would be something that would be really detrimental to gold.
Yeah. But, again, we'll see. Well, I mean, Trump wants a weak dollar in for export purposes, right? But I guess we probably won't even get there. I'm not even going to complete my thought on that because I agree with you. And in a way, thank goodness we have the feedback from a market economy weighing on stocks, and that's sort of a natural form of checks and balances, whether it's Trump, whether it's a Fed chair, whether it's something else that sort of keeps people in line. I would editorialize.
Well, if you think that keeping in line is running a $2 trillion deficit,
fair,
that's a very odd definition of what keeping someone in line.
Fair point. But I mean, it would at least keep them. Yeah. So I'm glad you said it, because the negative then is the masses. The market is short-term focused, and it wants the punch. Wants the Fed to keep spiking the punch bowl. It wants the party to continue. It doesn't want responsible plans.
I think a better way of saying it is that the market is the liquidity junkie. And as long as it keeps getting fed, then we're going to see higher prices. And if for any reason that liquidity becomes under pressure, that's when we see prices go down.
And the breaking point on the upper end, and this is something that's really only theoretical, but there have been a lot of voices for a lot of years saying, hey, eventually this is going to go bust. At some point, the credibility of the U.S. could come under further scrutiny. I mean, the party can't continue indefinitely. At some point, so much liquidity could be created under such incredulous or ridiculous terms via monetization or whatever that people just start moving away from the U.S. market. But it seems like we got more runway on that front. What do you think?
I think we've got a lot of runway where the USA is growing at 4% a year. When you're talking about the largest country in the world, the largest economy in the world, growing at 4%, you can do a lot wrong, and it's going to paper over a lot of cracks. There's, we still have, energy that is not challenging. There's, incredible technological innovation going on. We're getting a lot of uncertainty right now, but I think that the economy is just going fine. So a lot of what happens in the market, is because there's a lot of leverage and because valuations are high. That doesn't necessarily translate into the health of the wider, economic situation.
Speaking of which, let's do Japan after this next one. So the U.S. job market, Owen, as you have certainly seen by now, did better than expected in January. This is the New York Times that I'm showing here. It added 130,000 jobs and prompted Trump to issue that statement about how great the U.S. economy is doing and how for sure we need to lower rates because of that. My question is, and look at the 10-year. I mean, the yield plunge, which means people felt good. They were buying the 10-year bond, which they've been kind of moving away from after the Kevin Warsh news. So my question is, does Trump's logic really make sense? I mean, normally, wouldn't you cut rates to stimulate an economy if things were kind of sluggish?
You got to also look at the sort of the revisions because, yes, the January jobs number was good, but they revised the total jobs for 2025 down by 1 million jobs. So all of those people talking about a vibe session in 2025, that was very real, that there was 1 million people lost their job. That's a really significant event. And it does point to an economy that was under stress. And I think the big question right now is whether that has already bottomed. And the economic stress that we were seeing in 2025 might be over already. That's, I think, the big question right now. Now, then we're at a point where, if the stock market is under pressure and then bonds are starting to rally, then what that's really starting to potentially price in is that we do get interest rate cuts later this year.
Yeah, Kevin Warsh said one thing he wants to do is become less data dependent at the Fed and more just based on ideas. And it sounded like his logic for that was that, as you pointed out, the data gets revised so much, be too jumpy based on any 1 or 2 points. Basically, it could change a little bit later. It would just seem, I mean, and maybe I'm oversimplifying it, but, on broad brushstrokes, the economy is pretty hot. The job market is not as bad as one would expect. It would just seem for a normal Fed chair to, and again, he doesn't cut rates, as we talked about in the last show, by himself. It's a committee that decides, and he is but one vote. So it may or may not happen. But it would not look like a normal environment to cut rates, at least to me. I don't know if you disagree.
I think the Fed being data dependent and then relying on lagging data is the main issue. But also flying by the seat of their pants and cutting or raising rates based upon their personal opinion, that's not a great idea either. There's a good reason why they have become data dependent over the years. Because they're more likely to make mistakes if they base their decisions on emotion. Of course, what they could do is just look at the 2-year yield, and that would be a pretty good indication of where rates should be, and just follow that. And in fact, that is what they do tend to do. It's just with about a 3 to 6 month lag.
Interesting. Speaking now of rates and of economies, but not the U.S.'s. Japan's stock market rose to at or very close, at least, to an all-time high. Investors love Prime Minister Sanae Takaichi. China, in fact, backed down. They were kind of threatening some economic coercion around rare earths because she said that if China were to attack Taiwan, Japan would probably get involved militarily. And of course, PRC didn't like that. But then instead of getting the Japanese populace against her, it seemed like the Chinese threat made the populace support her even more. So she's got a lot of support from both voters and from the market. My question, Owen, as I share a screen of the Japanese stock market, if one looks at the, hold on a second here, Nikkei 225, it's only about 2 years ago that it finally surpassed the level it set in January of 1990. 36 years, a little more than 36 years ago as we record this. So my question is, there's optimism around Japan. Warren Buffett has been buying into Japanese stocks, or at least last year he did. Almost everyone seems to like this new prime minister, but Japan's got some pretty big demographic issues, some corporate competitiveness issues, stuck in the old ways of doing things issues. Will she be enough?
Well, I think that what she's doing is revitalizing the economy and following through on Abenomics. And Abenomics was introduced in 2012, and it has been the defining policy of successive Japanese governments. So,
and for someone new, what is in terms, I know loose money, but how else would you define it?
So Shinzo Abe was the prime minister at the time, and it's really around three. They call it the three-arrow policy. The first arrow was massive monetary accommodation from the central bank. The second was that they were going to be much more liberal with fiscal spending. And the third was that they were going to have institutional reform, particularly around the banking sector. And obviously, the institutional reform is the one that's the hardest to achieve. But what it really meant was that there was very clear coordination between the government in spending and the central bank in issuing more debt, or buying that debt and issuing more money. The thing that it has done is it's revitalized inflation in Japan. It has massively inflated asset prices, and it was absolutely dire for the yen. The yen has halved in value over the last decade. And that also helped to really push up asset prices. And the lesson that I find is most important is that if you look at those three arrows, well, all of this talk about coordination between the Treasury and the Federal Reserve is very similar to Abenomics. And regulatory reform inside the economy, whether that is reducing regulations on the banking sector, on lending, on housing, on mortgages, or on environmental concerns and the energy sector, that's also very similar to what we're seeing in the USA. I think that really what the Trump administration are doing is adopting Abenomics and saying that that is something that could really help to revitalize the economy. But I guess the victim of that would be the dollar.
So do you think, and it's interesting because in a way it combines liberal economics with conservative everything else. She's more anti-immigration. She wants a stronger military. Those are traditionally conservative positions. But Trump is also not really a traditional conservative president economically. He wants just to juice the market. So it's combining two things that at least maybe someone 50 years ago might be surprised to see them combine, whereas today maybe it's not as big of a deal. Would you be a buyer of Japanese stocks writ large or bonds writ large right now?
I think I would be very interested in the defense sector in Japan because they have a pacifist constitution, and that really means they're starting from zero, and they need to really significantly increase that. So I think that's pretty obvious. I would also be a buyer of the yen. I think that if the USA is adopting Abenomics, that's actually bullish for the yen, negative for the dollar. So I think the yen has got room to rally.
A race to the bottom, right? Yeah.
And the yen is one of the weakest currencies in the world. So if you do get a rally, then there is real potential for a significant move there.
So you heard it first from Eoin Tracy. If you're thinking about traveling to Japan, the time is now before that yen rises. All right. Final story before we get to the stocks we're looking at. Alphabet, Alphabet issued a 100-year bond. It was 10 times oversubscribed, just £1 billion, which is kind of, small change for a company like Alphabet. They're paying 6.05% interest is the current rate. Do you have a view on this? I mean, was it necessary? Is it just an indication of how hot AI funding is that somebody can get away with a 100-year bond? They've been issued before, but normally by governments.
Well, I think the big parallel in markets right now is the one that Motorola issued in 1997. And that was when they were a really hot commodity in the tech sector, and the company doesn't really exist in the same way anymore. So betting on a company lasting for 100 years, that's a really significant wager. And generally speaking, what happens is these 100-year bonds, they trade significantly below par. So they tend to be issued below par and they trade below par for a really significant amount of time. And they're seldom going to be a good investment.
And I would imagine that the return of print, I mean, if you were to literally like chart out the money flows, the return of the principal is negligible as a percent of all the inflows you get. Obviously it comes in 100 years too, which.
Well, you're going to be dead. So anyone who's buying it is not worried about return of principal. They should be worried about the performance of the bond and where the yield goes over time. And usually those yields rise because you don't know what that company is going to do in 100 years, and you're not going to be around to collect your principal anyway.
But 6.05% from basically an investment grade corporation is pretty good too. And I guess that's why they're paying that much.
Yeah, but that's because the people buying it are insurance companies, so they'll never sell it. They'll always pick up the 6%.
And I'm guessing they need to match their liabilities to assets, and the 100-year duration kind of like lets them check that box, essentially.
That's all it is. It's checking the box. It's never going to make money.
Yep. Interesting. And that's probably why it's only $1 billion, which sounds like a lot to you and me, but for a company like Alphabet, multi-trillion-dollar market cap, and their spending on AI is probably, I don't even know what it is, but it's a lot more than £1 billion.
But it's also that this thing was being marketed as a book of about 6 billion, and they sold it 1 billion. So I mean, it really is a nothing burger.
Yeah, it's headlines. It's stuff for us to talk about, but economically, it's almost a non-event. But speaking of stuff that hopefully could be more an event for you if you're an investor, let's talk about some stock ideas that we are watching. Owen, I'm going to bring analyst Xiaoping Huang on to get her idea, but as I do that, what are you looking at this week?
I would be very defensive right now.
Okay.
So I kind of like Costco. And
all right.
The share has been coming down for the last 3 or 4 months. It's just starting to rally. Walmart has really done all the running, and I think Costco has room to play catch up here.
Gotcha. I'm looking at the stock. Let's see. Yeah, down 6% over the past year, up 17% year to date. So you're right. It's definitely starting to rally. Over the past 5 years, up 184%. Charlie Munger was a big Costco fan. I know that. This has always been one of those shares that I wish I'd bought a long time ago, but it always looks a little on the pricey side. So maybe you're right. Maybe the time is right. It's coming up from the dip. Certainly a high quality company, pays a modest dividend. PE is a little expensive, but you're paying for something good. So Costco. Xiaoping, what are you looking at?
I'm looking at AMD.
All right.
So it's all like AMD is always like one step behind Nvidia, trying to prove it can catch up. But like it just posted its best ever quarter, but the stock price still dipped like 17% in just one day. So but their revenue was like up like 34% year over year, and earnings are just way above expectations. So, and also they guided higher than Wall Street for Q1. Their data centers is now bringing over like half the company's total revenue, and AI chips is doing really well, but like 390 million from China in Q4 alone, and they're like deal with OpenAI could like worth billions over time. So it also PC and gaming bounce back, and the console side is really like holding really strong, and their financials is really good. Margins are expanding, and free cash flow is good. So like I think like this pullback could be could start like making this stock like looking more like interesting.
And Google has £1 billion more to spend on things AI, right? Yeah, interesting. So kind of similar to Owen's idea in a chart sense, although this one hasn't yet started any rebound, but a company that took some licks lately and may come back. Certainly, it's in the right space. So my company is going to connect to an interview that we just posted with Stuart Winchester, a who basically created the niche of journalism for lift service skiing. Vail Resorts, MTN, is the stock. This is about a $5 billion company. It is just on my radar in the sense that I don't know how much I want to beat the drum on this stock yet, but down 53% over the past 5 years, excuse me. So it's kind of this left for dead company. People think global warming is killing skiing. It's actually not, because as Stuart said, the snowmaking is getting so much better. We've added a massive amount of skiable acreage here in the USA, the equivalent of the size of Colorado worth of ski resorts, which is the most ski resort intensive state. So skiing is actually getting better and better, thanks in part to Vail. It's got this sharp elbowed CEO who was in it for a while, then left, and now has come back. So that's probably bad if you're a competitor, but probably good if you're a shareholder. So I'm not yet ready to pull the button on buying Vail Resorts, but I certainly like a beaten down stock that could have a turnaround story. So that is my stock for this week. Owen, are you
It's just worth mentioning too that Colorado hasn't had any snow this season.
It's been a horrific.
It's been like the worst season in decades.
Colorado, I think the all-time lowest snowpack on record for Colorado and Utah. And, snow sports, that's a big part of their economy. So I certainly am sympathetic to those states, and hopefully next winter is good. But, they had some good winters previously. So that's another probably not helping Vail's stock either. Oh, and do you ski at all?
I would rather protect my knees.
Okay. So that's a no. Snowboarding is safe for your knees, but it's not safe at all for your wrists or your butt, because your legs are locked in, but you fall both ways. And I ski. I have snowboarded maybe 20, 25 times in my life, and felt pain every single time. But I'm not really selling it, am I? I'm making it seem even less attractive than skiing. But anyway, Xiaoping, when did you last get out on skis? I know you're a skier.
I'm gonna go snowboarding this weekend.
Okay, near LA, right? Like Mountain High or Big Bear, Snow Summit, Bear Mountain. I mean, one of those there.
I don't know. I just follow my twins.
I was just for kicks. I was checking those webcams. It's all bare ground except for like a little sliver of snow on the trails, which I remember going to those resorts, 30 something years ago, and even pre-Christmas, you'd have a meter of snow on the ground, just everywhere. It was just night and day. And again, winters ebb and flow, right? But this winter is not the best for the West. But fingers crossed that we get a storm before you get out there shopping. So, guys, fun to chat skiing and stocks. Hope you guys at home enjoyed this show. Again, any stocks you want us to talk about, topics, just let us know. We're always happy to field your questions. Eoin Tracy of Fuller Tracy Money, Xiaoping Wang, analyst at Curia Financial. Thanks as always for doing this show with me. And thanks to you guys as always as well for watching us at home.